Welcome, everyone. I'm Zeb Low, director of the content studio here at HousingWire, filling in for Sarah Wheeler. And today I'm talking to Logan Mohtashami about the latest housing data and the Fed's next steps to avoid a recession. Logan, thank you for thank you for joining me, but I'm a poor replacement for Sarah. So thank you.
Sarah's in Hawaii right now, so I called her and I told her, I said, "Hey, listen, just remember we got our podcast today." She's like, "What? What is?" I played a joke on her that no connections could work, and she had to come on. But then I said, "No, you're okay."
Well, thank you for letting me sit down with you today. I'm looking forward to a lesson in Loganomics with the chart daddy himself.
Yes, the chart daddy is ready to go. And today's topic is really, this is Monday morning. Obviously, I wrote the article about this on Friday. But does the Fed need housing back to prevent a recession? And, so much of my work over the last 14 years is really tracking economic cycles and then housing. And traditionally, what we always see before a recession is single-family permits fall, 5-unit permits fall, housing starts fall, residential construction workers tend to lose their jobs because demand is not there. And then that would lead to jobless claims rising, unemployment rates rise, there's your recession. That has not happened in this cycle, which is very abnormal. This is a very, very historically unique cycle. When home sales were crashing in 2022, single-family permits were falling, but 5 units permits were increasing. We have this huge backlog of homes, 5 units and single family that hadn't even been started yet. It takes 21 months to finish a 5 units. There's all these things that are so unique about this cycle. And what it's done, it's allowed people to stay employed and keep the work going. But 2024 is different. And the reason I highlight this is for the past few months, we've been talking about this in podcasts. I've gone on CNBC. I'm going to be on CNBC this week again to talk about it. 2024 is different in the sense that single family permits have been falling and 5-unit permits are at recession lows and employment is still rising. So that's one variable that's different. But now the remodeling sector is putting up red flags. And the reason we talk about that, because that's the big tamale in the residential construction workers is remodeling. And when Home Depot warned last week about, hey, listen, the business is slowing down, we're not hitting our comps, remodeling. Now you got all of them in together, right? So this is the first time that we have all the variables in together with unemployment rates already rising. So if you lose this sector, then job growth slows down, unemployment rates rise, jobless claims go up, unemployment rates rise. Then you have, well, guess what? This could actually take you to unemployment rates of 4.9% and higher, which is not part of the Fed model. And housing's been disproportionately hit terribly for many years. But the existing home sales market is more of a transfer of commissions. It's not, people building homes or construction jobs. So we're in this part now that we're going into a period of time. If this continues, you're going to lose jobs. And when you lose jobs at this stage, after being very restrictive policy for times, this is now on them because this is the one sector that they do kind of control if they wanted to. And the question is, rates have fallen down recently. The builders' confidence index is getting a little bit better looking out 6 months. Can they push this through to make sure we don't lose this sector and have unemployment rates go up higher? This is going to be the battle for the next, 16 months because this is the key sector in the economy for that.
Interesting. And so if this doesn't work out, like worst case scenario, what does this look like?
This looks like we'll start losing construction workers in the 5 units and the single family. More single families more tied to smaller builders than the big publicly traded builders. Remember, and this is one of the big differences is that the publicly traded builders in this cycle, their gross profit margins were over 20%, which means they have some leeway to make some moves. And I don't think a lot of people even looked at that data line as anything valid, but for them, they can pay down rates and sell product. But smaller builders and 5 units, not so much. So you will start to see residential construction workers instead of creating jobs, losing jobs. And then when we look at the past few recessions, of course, we take COVID out of the equation. This typically is the case. They tend to lose their jobs and then the recession happens after. So now that we know, and I think a good example is this, one of the Fed presidents from the St. Louis Fed, he talks about, well, we're very restrictive policy. So I'm talking about cutting rates. I'm comfortable with cutting rates, but we're going from very restrictive policy to less restrictive. And I'm like, thank you. This is my talking point for a very long time. The Fed hasn't pivoted because in their minds, they are restrictive policy. Even if they had cut rates 3 times, they're still in restrictive policy. If you're talking about going to neutral Fed funds rate, which is 8 rate cuts, that's a whole different thing. But that's just taking yourself to neutral. There's nothing here about, well, we're losing jobs now. That means you got to go from restrictive to an accommodative stance. So we're playing with fire that at this stage, you don't really need to. So rates have fallen down, but like we've always said here, whenever rates fall down, demand picks up a little bit, then they shoot right back up and we lose it. And now we finally have it to where single family permits are down, 5-unit permits are down, and the remodeling sector is getting hit. So this is much different than I would say 2022 and 2023. We have everything in the components, and those are the 3 categories really for residential construction worker.
Okay, so I have a couple follow-up questions to that. So if you had your magic wand, if it was all up to you, what would you do?
First of all, no man should ever have that kind of power, even me. And I would basically come out and say, I'm going to be Jerome Powell. Mm-hmm. We have been very restrictive. We understand that we have been overly burdened toward the housing market. And I believe, and so does the Fed president, that we need to get home sales growing again so we could get construction growing again. So we can believe in this concept that Logan Mohtashami has told us time and time again, the best way to deal with inflation is supply. Demand destruction is a very short-term, fix, but eventually it hits the supply or in the production lines, and we're there now. So our job is to make sure that we get rates low enough to consistently grow home sales. And in that context, the builders can feel a little bit better on building more homes so we can get more supply. And once that house is built, that sits there for a very long time. People come and go, but supply is the best way to deal with inflation. That's what I would make it to the public. And we will do whatever it needs because the spreads are really bad right now. And if the Fed really wanted to, they could say 2 or 3 cents to change that. But if you just get mortgage spreads back to normal, what we've seen since the early 1970s, that's another 1% lower in mortgage rates. And then if the 10-year yield falls a little bit, you don't need, 2.5 to 3.25 mortgage rates, but you do need lower rates to stay longer. And this way, the builders can feel more confident about building homes, and then we can push that forward. And there's your supply issue because, it's just one of these things. Every economic cycle is kind of the same. Rates go up, builders permits go down, they start laying off people, housing construction holds off, then rates come down again, demand picks up, and we build. So we're at that cycle to where we can get ahead of the curve a little bit. We don't have to stay restrictive policy. The inflation story is we're not re-accelerating inflation. There's no supply shocks anymore out there. Wage growth is slowing down. All the things that the Fed wanted is there. They can change. My argument has been that they're too afraid to until the labor market gets really weaker and they go, oh, listen, we have to cut. We have to do this because our dual mandate. But here you can, if it was me, this is what I would be saying to the marketplace. And I would say, I assure you, we will make sure that the builders keep on building because supply is really the best way to deal with inflation.
Now, I have to say, whenever I mentioned the magic wand, you said that no man should have that power. Your eyes did light up a bit. So there was a twinkling.
Oh yeah, nobody. There should never be an omnipotent, all powerful person in the world that has that much. You cannot. The history of humanity is that's never a good thing. An institution or people, a democracy, but one person, oh more. That's putting too much faith.
So I know what you would do. Okay. But what do you think Jerome Powell will do? What do you think is the most accurate prediction for the future?
Well, they're going to cut rates, and they're going to say we're going to keep an eye on the labor market. So this is why I say that the housing market is kind of your front lead. Now, of course, we have other sectors of the economy that are losing jobs. Of course, we've seen all the layoffs in the tech industry. The tech industry also has severance packages that you can be unemployed longer than people think. But when the residential construction workers lose their jobs, I think they'll be a little bit more maybe transparent. But I always say that once we see the labor market start to break, the 10-year yield itself will start to go lower ahead of the Fed. That's what historically happens. The Fed will be old and slow again, and then they'll come 6-8 weeks later, and then they go, well, we're thinking things are getting, and then the next meeting, they go, okay, it looks like it's, and then the third meeting after that, they go, we need to really cut rates. So I think the bond market will be ahead of the Fed on this once they see jobless claims rising. We're not quite there. We've already made a good move lower in rates, but to secure the deal, the Fed will, wait till the very last second. And then once the labor markets really start to break, they'll kick in. But until then, hopefully the bond market gets ahead of them like they've tried to do in the past. And it's been actually beneficial for housing, especially at the end of 2022. But it just gets more interesting going out the next 16 months now because of, for the first time in many years, all these variables are in play. And that, again, we believe in economic models, and the numbers are the closest thing to the handwriting of God. So we actually take it and go with it. And that's what the data is telling us right now.
So recently was the last dip in the rates. We saw, what were we calling it? Like a mini cycle, like a refi cycle or a mini purchase cycle. And would you say that's with this next rate cut pretty much going to be the same thing? And the subsequent rate cuts, just mini cycles?
I would say this. I always tell people, don't focus so much on the Fed's rate cuts, but focus on where the spreads are going. Because if the labor data starts to get weaker, mortgage rates have already made a 1% plus lower move already without any rate cuts because the bond market will get ahead of the Fed. But what rate cuts and a more dovish Fed can do is get the mortgage spreads better. And it has this year. I think the terrible story of 2023, and there was a lot of bad things in housing in 2023, but the spreads got really bad because after the Silicon Valley banking crisis, spreads were getting better, and then that threw a wrench into everything. And the spreads got to pre-cycle highs, and we got 8% mortgage rates. The Fed needs to make sure that if you're talking about rate cuts and doing rate cuts, get the spreads back to normal. And then that does a lot of heavy lifting on their side. The bond market will do the rest, but start talking dovish. And those rate cuts can actually help the spreads, but really the bond market will kind of run the show. And a lot of people know I'm a 10-year yield guy. That's my entire life. So basically, I've said this 380 level is just going to be a really pest right now. And it has been. We haven't been able to break that. And I always thought you need more material weakness. But I just don't want to be like, I don't want the Fed to wait until that moment, to go. I want ball players. I always say, we want ball players. We don't want people that sit there and go, I need to wait until the labor. No, we want winners. Get ahead of it. And in that context, now you have leeway to do this. And also, this is one of the reasons why I say, I am so much more happier about housing 2024 than 2023 because inventory has been growing for the existing home sales. We're no longer at the savagely unhealthy inventory levels. So we can have rates go lower and demand pick up without home prices going up 15 to 20% nationally. So we're in a good spot to do this, but the ball's in their court. And, where I couldn't say this in 2022 or 2023, now those three variables for residential construction are all coming in together. And with Home Depot warning last, those things are real. And that's how economic cycles have worked. Mother Economics is a serial killer. She will leave you clues until, she wants to get caught. So we're catching her. She's leaving us clues. We just need to get that to the Fed. And then the Fed goes, okay, we overdid it, but now we're okay. Well, let's push forward and make sure the construction cycle can keep going.
And where do you see, you mentioned it just a minute ago, and that was the first time you brought it up in this conversation. Where do you see housing affordability factoring into this overall?
Okay, so this is a very, very good question. Housing affordability was worse in the early 1980s, and nominal home prices did not crash back then, even though we had a recession, even though inventory was higher, even though mortgage rates were double digits. Did not happen. And not a lot of people know this. And again, I blame myself for not explaining this over the years. It's really rare in America to have nominal home prices fall, especially crash on a national basis. So the only way to effectively attack affordability is keep the employment cycle going as wages grow. Now, the Fed in itself is hurting the affordability issue in terms of targeting the labor supply, which means wage growth goes down. So that's part of their model. It was something I've always talked about. The Fed wants to attack the labor supply for wages to go down. So there's nothing we can do about that. Wage growth is slowing down. But if you keep employment going, wage growth can still grow, even though it's slowing. And then if rates fall, affordability and rates together, historically, going back to 1942, those two things really impact affordability the most. There has only been one period in time in history where we saw nominal home prices crash big enough to really impact affordability, and that was 2007 to 2011. That was the housing bubble crash. Tons of inventory, tons of forced credit sellers. We don't have that marketplace, obviously. We're still at all-time high. So it has to be a combination of keeping employment going, keeping wage growth going, and then rates falling. And then, of course, higher rates, what it has done is created more inventory, so the price growth is cooling down. That's a positive. So you have everything kind of in place. Price growth is slowing down. Wage growth is still growing, just not as fast, but you don't have the rate variable. And I'm staying consistent to what I've said for the last few years. The only time I've seen home sales grow is the sub 6% mortgage market. The builders have done this, right? The builders have paid down rates and they're growing sales out. Builder sales have slowed down recently. But their forward-looking indicators are starting to get a little bit better. So lower rates helps affordability. If mortgage rates were at 4% today, and I ask this of everyone, not that I think we could get there anytime soon, but hypothetical, humor me. If mortgage rates are at 4% today, everyone listening, do you think home sales go up or go down? From where we are today, it is record low levels of sales. Again, third calendar year. We're missing about 4.2 to 4.7 million traditional home buyers in this 3-year period. It's about 1.3 to 1.7 million per year. Rates go down, demand goes up. Why? Because affordability gets better. That's the way to do it. And that's how we've seen this throughout cycles. Household formation is a very big key thing. Millennials are still massive. Gen Z is still massive, right? You create more households, you get more dual household incomes. That's the way that you fight affordability, because we don't have much history on big nominal home price crashes nationally. There's parts of the country that are off from the peaks. They have become, in a sense, more affordability on price, but not on rates. And then we also have other issues where property taxes and insurance makes housing more unaffordable. We see that in Texas and Florida, some condo issues as well. So the other variables, but if you got lower rates to stick there, I'm telling you, sales will grow, because that's what happened in the early 1980s. We had terrible affordability. We had recessions, everything. All of a sudden, mortgage rates went lower, stayed lower, never went back up. Sales grew because home sales crashed back then. We went from 2 million to 4 million down to 2 million. And then as mortgage rates headed lower and stayed lower, demand picked up. Household formation, income, wages, rates, put them all together. There's how you grow sales. So I'm not saying that rates are going to 4%. It's not a part of my forecast, but think about it. If rates did, why would sales grow? It's because affordability got better.
Let me ask you that. Do you think that maybe the difference between the 80s and now, the early 80s and now, is that we might be dealing with a different type of home buyer now as well?
Well, the big difference is that we have 5 generations buying homes now. I mean, between the Gen Z, millennials, Gen X, nobody cares about us. I'm telling you, nobody cares about Gen X. And we love that. We love that. We think you boomers and millennials should fight with each other forever. Baby boomers, there are still silent generation buyers. So the big difference is that we have a lot more people right? We have a lot of household formation. And I've always had this thing in the previous decade, for people that haven't followed my work in the past decade, I've always said housing was always going to be a year's 2020 to 2024 story because of what I'm about to say, because people rent, they date, they mate, they get married, 3.5 years after marriage, they have kids. More than 50% of people who buy homes are married couples. We have a lot of single people still buying, but that's how traditional home buying works. We buy homes a little bit later in life. Of course, this is not the World War II generation anymore, where we're creating families at a younger age, but we still buy them at a certain age. So I think we just have 5 generations ready to go here, and mortgage rates, even at whatever 6.5%, are roughly kind of in line to what historical norms are. Let's take the late 1970s and early 80s out of the equation. You could kind of see it. That's good. I mean, and also, as you have an aging population, you have again, 70 to 80% of sellers are buyers. So you do have people that sell their homes, buy, whether they have to move up or move down. We have, I think, close to $50 trillion of home values in America. The only thing that I would say that is maybe a wild card for maybe the next month or two is that the commissions have changed, the structures, and it might take a few months for people to adjust themselves in terms of taking longer to buy a home. For those of you that might remember TRID, when TRID came into play, that first month was just absolutely chaos. It was such chaos that we had a big crash in monthly home sales because transactions took longer to finish, and then they all finished in the next month. So sales rebound back. This is something that we'll keep an eye on over the next 3 months. Is it just going to take a little bit longer to get a transaction done? Because in some cases, it might not be as apparent on what the commission things are. So that's something to keep an eye on. But again, housing economics is really pretty boring. People age, they get married, they have kids, they buy homes, they buy single family homes, and they live in them for a very long time, and then they die. That's it. Nothing too spectacular outside of that. But we have a lot of people, over 162 million people working, non-farm payroll plus self-employed, 336 million population. Existing home sales trending around 4 million is historically the lowest level ever. So it doesn't take much to move the needle. But it does need the one variable that changes a lot of things, rates. Rates would be the fastest way. And we've seen that. We've seen that in the last few years. Late 2022, rates go down, demand picks up. Late 2023, rates go down, demand picks up. Even now, even though some people are disappointed, rates fall, demand picks up. And even in the builders' confidence index, for the smaller builders that are more stressed than the bigger builders, they're out there saying, okay, the next 6 months, for the first time in a while, the previous 2 months have shown a positive data line. So sometimes it's the easiest thing. As a former high school basketball coach, you could do all these plays and fundamentals and everything, but when you just put the ball in the hoop more than the other team, you win. Here, it's just rates go lower, affordability gets better that way, and you pick up sales. It's been a very, very, very interesting year, and I tell you, I feel somewhat bad for my people that track economic cycles, because they were so counting on the recession in 2022 because they saw permits and starts falling. And it's such a unique cycle. It's a once in a lifetime where all these different variables, and you really have to follow housing closely to understand it. And it's confused a lot of people, even my really smart economic friends. It's confused them as well.
I've been paying, just because I knew that I was going to be talking to you today, I've been paying more attention than I normally do to you on Twitter and watching your engagements, I guess.
I throw down on Twitter every day because you get these scrub stock traders and doomsday people, and they've been talking about home prices crashing for 12, 13 years now. And no. These are not housing analysts. They're not professional people. You just ask them for their forecasts and they all run away. Cowards, frauds.
I was trying to track some of those conversations, and it started making my ears bleed.
Yeah.
Okay. Well, I think have we covered everything that?
Yeah, we covered.
You've got to share?
I'm gonna thank you so much for filling in for Sarah. And she does have to take a vacation here or there, but Sarah Wheeler will be back, and we have a lot. Oh, we have a lot of places to go. We're traveling a lot. Las Vegas, New Hampshire, New Jersey, Dallas, Phoenix, Chicago. No, there's tons of places that we're going to be traveling to. So for everyone there, the Nerd Tour is coming, and it's just going to get a lot more interesting out there. And unfortunately, I can't bring my cat with me in the backpack, but he'll be with me in spirit.
Well, Logan, it was a pleasure. Like I said, I enjoyed my first lesson in Loganomics, and I look forward to my next one.
Thank you so much.
All right, man. Have a good one.
You too.